In this lesson, we're going to discuss the price to earnings ratio, or PE ratio. Starting with the basic definition, a price to earnings ratio basically tells you how many times earnings you're willing to pay for a stock of a company. For example, if a company makes $1 earnings and you pay a 15 and the company's PE ratio is 15, that means its stock price is $15. It's the ratio between the company's stock price and the earnings, or the price divided by the earnings. Let's use a simple example. A company generates $5 of EPS standing for earnings per share, and its stock price trades at $100. What's the PE ratio? Well, it's price divided by earnings, or earnings per share. 100 divided by 5 is 20. So the PE ratio is 20, or 20 times. Usually we denote that as 20x, meaning for every $1 of earnings, you're willing to pay 20 times that earnings in value. Now, why would you pay more than, let's say, 1 times a company's earnings? Why are you willing to pay more for a company's earnings? Well, as a shareholder of a company, you are entitled to all the future earnings that a company generates, not just the next year, the next 5 years, the next 20. You own a piece of the company indefinitely, okay, forever. And those earnings are worth a lot when you discount it back to the present value. So we have a whole separate lesson on discounted cash flow modeling. The price to earnings ratio gives you a quick snapshot as to how much you're paying relative to a company's earnings, and it makes it very easy to compare one company to the other. Let's use a real-world example of Apple right now. Let's start with Apple's latest fiscal year earnings. So I'm going to bring in Google here, and I'm going to go to my tool to quickly find financial data, bamsec.com. I'm going to type in the ticker AAPL, and I'm going to go to the latest annual report, fiscal year 2019. From the home page, I could hit item 8, and I could get to the income statement. And in the income statement, I see that the company generated in the 12 months ended September 28th, 2019, they generated $11.97 in earnings. We're not going to discuss the difference between basic and diluted earnings now. We're just going to use the basic earnings per share. The company generated $11.97 of earnings in the fiscal year ended September 28, 2019. So I'll put that here into Excel, $11.97. What was Apple's latest closing price? So I'm going to go back to Google, and I'm just going to type in AAPL stock price. And I'm going to see that Apple closed today at $273.25. That was the latest closing price at 4. It should be at 4 o'clock the market closes. We're not going to look at the after hours here, which we discussed in a separate lesson. $273.25. So what was the current PE ratio based on the most recent EPS? Well, I'll do equals my price divided by my earnings. That's 22.8. Let's put one decimal. And again, I would think about that as 22.8 with an X at the end. A little shortcut I use there with an add-on in Excel, not native Excel. So 22.8 times earnings. That means for every $1 of earnings, you're paying almost 23 times for Apple stock price. Now that's using Apple's latest, most recent historical year. You can also calculate what's called, or what's known as, a forward PE ratio, meaning a PE ratio based on future earnings. Let's do that now. What is the consensus EPS forecast for Apple's upcoming fiscal year? To calculate that, I'm going to type into Google AAPL earnings estimates and NASDAQ. Okay? The NASDAQ exchange here, I'm going to use the first link here. NASDAQ will aggregate the analyst estimates, if I go down to yearly earnings forecast, I can see that in the next year ending September 2020, the consensus EPS forecast is $12.41. There's a high forecast of $14.37, a low forecast of $10.88. There are 11 estimates, and over the last 4 weeks, 8 analysts have decreased their estimates, and that's because we're in the midst of the coronavirus pandemic, and analysts are rushing to lower not only Apple's estimates, but the rest of the company estimate, other companies' estimates as well. So the consensus EPS forecast is $12.41 based on 11 analysts. So $12.41, I'm going to put in here. Based on how many analysts? We said 11, and we said that 8 analysts have revised it downward in the last 4 weeks. What is the forward PE ratio? Well, I take the stock price that we used above, and I divide it by next year's earnings, the September 2020 earnings. And I get a PE ratio of 22 times earnings compared to almost 23 times. Now, why is that? Well, on a forward basis, I'm paying less because earnings are growing. So the PE ratio is only 22 instead of 23. Now, one thing to think about here is, who are these analysts making these estimates? Are these estimates reliable? That's a very tricky part when you're using consensus EPS. Are the estimates stale? Okay. For a company like Apple, many analysts covered, 11 is a good number, and they update those estimates frequently. But for other companies that aren't as followed, you might only have a couple of estimates, and they might not be updated as frequently. So it's not always something you can trust. Additionally, the further you go out, typically the less reliable those estimates are. And additionally, fewer analysts will post estimates. So you could see if you go to September 2022, only 2 analysts are publishing estimates for that period. So you can't just say, well, analysts are projecting this amount of earnings, so that's a reliable number. What you really have to do is look at a bunch of analysts, look at a bunch of their reports, and maybe even come up with your own estimates. But it is a full-time job. That's what investment banks, hedge funds, buy side and sell side are doing all the time, is updating their models to come up with the best estimates. So with the PE ratio, as with many other things in finance, it's only as good as the inputs that you use. Now, one thing I didn't discuss before on the past year EPS is when you take that EPS number from last year, it might not be a clean earnings per share number. There might be some one-time adjustments that happen. Maybe the company had a one-time restructuring charge and maybe you need to adjust for it. On the flip side, maybe it had a one-time revenue deal or one-time income that you shouldn't include. The idea here is that we get sort of a stabilized earning number so we could get a clean snapshot of what the company's trading at relative to its earnings today. Let's discuss the drivers of PE ratios. Why would a company have a high PE ratio? Well, the 2 main reasons a company would have a high PE ratio, meaning that investors are willing to pay more for every dollar of earnings, is that those earnings are expected to grow. That's a very strong reason. If you expect a company's earnings to grow, you might be willing to pay, or you'll probably be willing to pay more for today's earnings or even next year's earnings in hopes that those earnings grow, and in the future you're essentially paying less. So growth is one of the biggest factors, if not the biggest factor. Another thing that would cause a high price to earnings ratio is stability. The more stable the company's earnings are, let's say the company owns real estate properties, or let's say it has a very competitive and dominant position in the market. The more stable those earnings are, let's say even like utility earnings, that, customers are paying month in and month out no matter what, you'd be willing to pay a higher price for that because you're getting more guaranteed earnings. Investors like stability. They like guarantees. They don't like volatility. So a higher you would typically see higher multiples on companies that are more stable, more dominant, more recession proof. Conversely, when would you see a low price to earnings ratio? You would see a lower price to earnings ratio if a company's earnings are not growing or even declining. And if that company's earnings are very choppy year in and year out and are subject to large declines in times of recession. So typically you would see cyclical industries like travel, airlines, hotels sometimes trade at lower price to earnings ratios because during recessions, those earnings might decline and year in and year out, they could be more volatile. Another reason to see a lower price to earnings ratio is if a company has a lot of debt. Debt adds risk and volatility. And especially in bad times like this during the coronavirus pandemic, a high debt load could increase the chances that a company goes into bankruptcy or financial distress. And investors are not willing to take on extra risk and pay a high multiple unless they're compensated for that risk. When you pay a high multiple, okay, you're paying more for every dollar of earnings. Let's flip the price to earnings ratio. Let's say you pay a 20x price to earnings ratio. That means for every $1, you're paying $20. For every $1 of earnings, you're paying $20. If I flip that, that's a 5% return. That would be a low return for the stock market. The stock market now trades at around 16, 17 times. You might be willing to take a lower return. If I flip it 1 over 20 is 5%. I'd be willing to take a lower return because I have more stability or more growth. But if I had higher leverage, choppier earnings, lower growth, I would need a higher return to compensate for that. Maybe the price to earnings ratio would be 10 times or 1 over, if I flip 10 to 1, flip it 1 over 10, that would be 10%, a higher return than the 5%. Let's discuss the benefits and shortfalls of price to earnings ratios. So first, why do financial analysts and investors use PE ratios? Well, they use PE ratios because it's very easy to calculate and easy to compare across companies. You might say, well, this company trades at 18 and that company trades at 15. So the company that trades at 15 looks cheaper because, I think it's going to grow just as fast. So I think that could be a buy. It's very easy to compare and calculate. So it's convenient for investors. Another reason they use it is it gives you a rough estimate of what you're paying or how expensive a company is pretty easily, and it does give you some sort of estimate. At the end of the day, earnings are extremely important, if not the most important thing that a company generates. So calculating the price to earnings ratio tells you how much you're paying for those earnings. However, there are many shortfalls. As we discussed in our DCF modeling video, the value of a company is the value of all its future cash flows. The PE ratio is only a point in time. You could only use one earnings number, let's say next year or last year. Maybe you could even do an average of 3 years, sure. But when you value a company, you have to look at all the future earnings. And by using a single earnings number in the denominator, you're not capturing the full value of the company. Another thing when looking at PE ratios is there's no way to account for growth. When I tell you Apple is trading at 23 times last year's earnings or 22 times forward earnings, that doesn't tell you anything about the company's growth. Again, it's just a point in time. It also doesn't tell you anything about a company's leverage or risk or stability of cash flows. So for many reasons, the price to earnings ratio has its shortfalls. It doesn't really tell you enough, but it does tell you something just to get you going. If you really want to value a company properly, you have to look at a wide range of metrics, ratios, and financial modeling. I definitely recommend looking into other videos and tutorials that we have on things like dividend yields, DCF valuation, and financial accounting to get a better picture, or I should say rather a complete picture on a company's valuation and prospects.